Imagine losing $725 million in market value in literally the first few minutes of your workday. Well, that is exactly what happened to Genting, Singapore on May 13th, 2026. You see, most of the world looks at a massive luxury resort like Resorts World Sentosa and just sees, a fun playground full of roller coasters and high-stakes tables. But the stock market, they see it completely differently. They see a giant machine with thousands of moving parts, and right now, that machine is suddenly hitting massive screeching friction. Let's dive right into this explainer and see exactly what broke. 725 million Singapore dollars. The sheer scale here is just staggering, but what is absolutely crucial to understand is the speed. This massive mountain of wealth practically vanished into thin air right at the opening bell. We're not talking about a slow, gradual leak over months. No, this was a sudden, violent rupture. And this brings us to the real problem, because this wasn't just a general bad day for the local market. It's a massive disconnect. Think of it like a lemonade stand analogy. Imagine two kids running lemonade stands on the exact same tiny, sunny island. One stand is hitting record highs, selling out every single day. That's Marina Bay Sands. But the other stand, Genting, Singapore, is watching its shares slide by nearly 9%. How in the world can two giant resorts, sitting in the exact same climate, have such wildly different financial fortunes? Well, if we look at a business overview released by Genting on May 12th, the numbers are pretty stark. Their net profit for the first quarter absolutely plummeted to $65.2 million. Now, to put that into perspective, they made $145 million during that exact same period last year. That is a massive 55% drop. And if you look at what's really the engine room of the resort, the gaming revenue, that dropped 8%, down to roughly $403 million. But here's the catch, and this is where most people get it completely wrong. The core issue isn't just that people are suddenly losing less money at the gambling tables. No. The real crisis here is the skyrocketing cost of simply getting those people through the front doors in the first place. Section 1. The Hidden Forces, Geography and Geopolitics. So this works like a brutal chain reaction. In their report, Genting pointed directly to the ongoing conflict in the Middle East and tensions in Iran. Now, you might be wondering, why does a war thousands of miles away matter to a theme park in Singapore? Well, step 1, geopolitical tensions spark. Step 2, that drives up global energy costs. Step 3, because fuel is suddenly way more expensive, airfares absolutely skyrocket. And finally, step 4, flying becomes a luxury, which sours consumer sentiment and travel demand just drops off a cliff. The big takeaway here? Macro global events trigger micro local losses. But that geopolitical chain reaction, that is really only half the puzzle. Recently, DBS Group Research downgraded the stock to a hold. An analyst, Chasing Feng, pointed out a fascinating concept that exposes Genting's geographical trap. He called it a locational disadvantage. We can actually visualize this trap pretty easily. Think of Marina Bay Sands as a shiny front-and-center shop right at the main entrance of a busy mall. Everyone naturally just walks right past it. But Resorts World Sentosa, it's literally like an island within an island. It is the shop hidden away in the far corner of the very top floor. So even with incredible world-class assets like Universal Studios, it requires massive activation efforts just to draw in the same amount of foot traffic. And that creates a totally brutal profit squeeze. On one hand, this giant resort is facing rising operational costs just to keep the lights on, things like electricity, logistics, and supply chains. But because they're stuck in that top floor corner we just talked about, they're forced onto this never-ending treadmill where they have to constantly double their spending just to stay relevant. They literally have to pump cash into seasonal events, heavy promotions, and entirely new lifestyle concepts, like the Bodhi Spa or trendy hot pot restaurants, basically just to bribe people into making the trek out there. Now, when a massive company faces this kind of intense supply chain pressure and geopolitical risk, they don't just roll over. They pivot to what analysts call an asset optimization strategy. Genting is doing a complete ground-up rethink. They are launching attraction season passes to lock in local loyalty. They're doubling down on sustainable hospitality by developing super low-energy resorts like the Laurus. Basically, they're betting that if they can't be the most convenient location, they can for sure be the most integrated and efficient one. And hey, for creators, entrepreneurs, and analysts paying attention, this is a huge signal. When a massive company retools like this, it points directly to where the next big investment and service opportunities are actually heading. So Genting's story really is a masterclass, showing us that just being big isn't enough anymore. You have to be wildly adaptable. The numbers always tell the real story that those shiny promotional brochures try to hide. Which leaves us with a strategic challenge for you. If you were running this multi-billion-dollar resort facing these exact headwinds, what is your move? Do you double down on high-end luxury to attract the few whales who are still flying? Or do you slash prices to make it a high-volume, affordable destination for locals? Let us know your business strategy in the comments below, and make sure you subscribe to stay ahead of the next major market shift.